Typically, when rates rise, both bond and stock markets will be affected. In most cases, their values tend to fall. Bond yields get bid up and consequently bond prices fall. Stock market may go down as a result of companies cutting back on their growth spending as the cost of borrowing becomes more expensive. In the past, Asian markets have experienced some losses during periods of rising rates, but they have demonstrated their resilience by recovering quickly. Take Asian credit for example. A large portion of them are short-dated bonds, which makes them less sensitive to US Treasury movements. Moreover, their spreads are negatively correlated to US Treasury yields and also have a low correlation with other asset classes, making them a good addition from a diversification perspective. Asian equity markets performed relatively well in the past rising rate periods, and historically dividend-paying stocks have been less impacted in the long term. These companies normally have ample cash flow and are supported by growing earnings. Stocks that are invested in sectors such as banks are also likely to perform better than others. Banks earn profits by lending money to borrowers at a rate from the long end of the curve, while paying depositors at a rate from the short end. Therefore, bank stocks usually perform well after rate hikes because interest rates tend to rise the most in the long end of the yield curve. So what should we invest in during a rising rate environment? The answer is to hold a balanced portfolio so it is less vulnerable to the impact of rising rates. You should evaluate whether bonds or stocks are a good investment now or at a particular point in time by keeping in mind the following factors: Fed interest rate outlook, market outlook, your investment objective, and last but not least, your risk appetite.